So, let's start. Hello everybody and welcome to this Sustainalytics webinar on our new real estate sector report entitled Two Steps Forward, One Step Back. My name is Hendrik Gartz and I'm the Global Head of Sustainalytics Thematic Research Team, and I have the pleasure of being your moderator for today's webinar. We are delighted that so many of you can join us today, and I would like to extend a special note of welcome to those of you that are joining us for the first time. For those of you who are unfamiliar with who we are and what we do, we are a responsible investment research firm providing detailed ratings and analysis on company environmental, social and governance performance for institutional investors to integrate in their investment decision-making processes. One of the many things that Sustainalytics does is to produce periodic reports on the sectors and industries that compile our wide research universe, such as the real estate sector. These sector reports identify key ESG issues that we believe are most material to the sector or industries in question, rate company performance against these ESG issues, showcase best practice, highlight leaders and laggards, and in general provide detailed quantitative and qualitative analysis that is highly beneficial for institutional investors in the asset allocation, asset selection, portfolio construction and maintenance, and engagement processes. I'm joined today by my colleagues Niamh O'Sullivan, based in Amsterdam, and Doug Morrow, based in Toronto, who co-authored this report, and in a moment will present the key findings and takeaways of the report to you. This presentation will take approximately 40 minutes and will be following by a Q&A session thereafter to allow us to finish the webinar at 4 p.m. Central European Time. Before we begin, I would like to highlight some housekeeping issues for you. You are currently all muted and will remain so for the duration of the webinar in order to minimize any noise disturbance. In this instance, we invite you to send any questions you have about the report or webinar to us through the interactive box you see at the bottom of the screen, here highlighted with the number 1. Incidentally, if you have any audio problems during the course of the webinar, you can also inform us of these through the interactive box. Also, if you would like to minimize this interactive panel, you can quite simply do so by clicking on the arrow at the top of the panel indicated by the number 2. Finally, this webinar is being recorded and a copy of this recording will be sent to all participants in coming days. So without further ado, I will now pass over to my colleague Niamh, who will begin the webinar presentation.
Yes, hello everybody. Thank you, Hendrik. As Hendrik just mentioned, my name is Niamh O'Sullivan and I am a member of Sustainalytics Thematic Research Team. By way of an agenda for today's webinar, I will begin by introducing you briefly to the real estate research universe that we use in this particular report. I will then move on to an introduction of 4 key macro industry trends that we believe to be most important for the real estate sector currently, and that are either directly or indirectly affecting company activities at a micro level. I will follow this by a brief overview of a special governance spotlight chapter in the report, in which we focus upon the complexity of real estate investment trusts, otherwise known as REITs, and also the accountability challenges associated with family firms. I will then pass over to my colleague Doug, who will present the 3 key ESG issue chapters in the report to you. And these particular chapters focus on energy use and GHG emissions, product sustainability, and business ethics. Doug will then highlight key leaders and laggards, key performers in the field with regard to these particular 3 ESG issues, and we will move then to a conclusion and some Q&A. So just to get started, by way of a brief introduction, to the research universe that we use in this particular report, we cover 286 companies in the report. And these particular companies come from a range of geographical regions, as you can see here listed on the slide. And the majority of these companies come from the Asia Pacific region with 127 companies coming from this particular region. These companies also come from a range of real estate sub-industries, and these are sub-industries that have been classified by the global industry classification standard known as GICS, which you can see here listed on the right-hand side as well in the graph. You see that we have a range of companies coming from diversified real estate activities, real estate development and operating companies also. But the majority of the companies that we cover, 137 of them, come from the REITs sub-industry. And this is because we include 9 different varieties of REITs in our particular universe. And these range from mortgage REITs to industrial REITs and also healthcare REITs. And the specific breakdown of these companies is listed in detail in our report. So that's a background context in terms of the universe that we're using in our report, and I will now move on to particular industry trends that we focus upon in the report. And as I stated, we discussed 4 key macro trends that we believe to be very important for the real estate industry at the moment. And the first of those relates to the influx of finance into real estate, especially post-financial crisis. And what we see in the real estate industry is that in 2014 alone, global direct investment into the real estate industry was estimated at $700 billion US. And this was estimated to increase this year by 10 to 15%. And you might be wondering what is actually causing this influx of capital into the real estate sector. Well, quite simply, post-financial crisis, when there was low interest rates, and indeed as is continuing at the moment, and also when there was poor yields on bonds, especially associated with fixed income, investors were forced to consider alternative asset classes in order to stabilize their cash flows. And that's why real estate became a very attractive asset class for them post-financial crisis. So what we see is an influx of capital into real estate, and at the same time this is paralleled by a growth in the number of real estate investment trusts internationally as well. And as you can see here in the graph on the right-hand side, in the US alone, there was a steep increase in the number of REITs between 2009 and 2013, ranging from 50 to 150 REITs in the US alone. And this growth of the REITs and the overall influx of capital into the real estate sector has had a number of different repercussions. And we pick up on one of them in particular and discuss this as the second key trend in the report. And this particular trend relates to the effect of the influx of capital on residential property prices and the impact that this can and will have on the millennials generation in particular. And we note in the report that a recent IMF survey has stated that household prices are rising quicker than incomes in 33 major economies in the world today. And these economies encompass North America, European countries, Australia, South Korea, and Japan. And the effect of this is that the prospect of long-term, if not lifelong renters is becoming ever more prevalent now in society. And this is causing some concern in the real estate industry, especially when we're considering that the millennial generation are now starting to step on the property ladder and may be forced actually to become lifelong renters as opposed to being able to acquire their own property themselves. But commentators in the industry still note that we have to wait until at least 2020 to see whether this particular trend is going to materialize. Nevertheless, in the interim, what we do see is that this rise in property prices, residential property prices, is causing a surge in demand for multi-residential properties and also mixed-use developments. And this in turn is causing indirect and direct effects on our third key trend that we focus upon in the sector report, which is green building. And as we've seen over the last few years, there has been a dramatic increase in the level of green building activity internationally. So much so that it's been estimated that the amount of green building has increased from 40% in 2012 to approximately 60% in 2015. And if we look at Singapore itself in the graph on the right-hand side here, you can see that approximately 89% of the current building activity in Singapore at the moment is considered to be green. And this is quite impressive when you think about it, that almost 100% of the building activity going on in Singapore at the moment is considered to be green. And we attribute this to quite generous governmental incentives in the green building space in Singapore over the last few years. But more broadly, internationally, the global share of green building has been estimated as $260 billion US dollars recently, and we believe that this is going to increase in coming years. And as we see this growth in green building, we see the parallel co-evolution of the actual concept of green building itself, to open up to consider the broader social dimensions of building and the actual effects of buildings on occupant health and well-being, and indeed productivity when it comes to the working environment. So much so that at the end of last year, in October 2014, we saw the launch of the first social building standard, known as the Well Building Standard, which was designed in effect to be a sister standard to the more well-established LEED standard, or Leadership in Energy and Environmental Development, for the green building activities over the last few years. And what we think will happen over the next few years is that when we see this co-evolution of this green building standard and the social building standard, as well as the proliferation of other green building council codes and standards internationally, that the whole concept of green building is actually going to evolve into one of more sustainability building. And this is something that we pick up on and we discuss in more detail in two of our main ESG chapters at the end of the report. This is namely the energy use and GHG emissions chapter, and also the product sustainability chapter. And my colleague Doug will discuss this in more detail in just a moment. And then we move on to our final trend in the report, and we perhaps take more of a business ethics and governance slant on this particular trend, and we focus on the increase in both financial and sustainability transparency in the sector in recent years. And we start off by documenting how traditionally the real estate sector has been very poor when it comes to the actual transparency associated with its basic financial performance and also governance activities. And this has caused a lot of concern throughout the industry, and also for regulators and investors in the last few years in terms of the level of potential corruption in the sector itself. And as a result, we have seen an increase in regulation for REITs, for example, and also more stringent listing requirements for REITs. And this increase in financial performance transparency now in the sector is having a sort of spin-off effect, or a spillover effect, onto sustainability reporting and transparency in the sector. And we see an increase in the level of sustainability reporting in the sector in recent years, assisted in part by real estate specific sustainability tools and benchmarks. And one of the most notable of these particular benchmarks is the GRESB benchmark, which is a global real estate sustainability benchmark that was launched here in Amsterdam in 2009. And this essentially acts as a survey on ESG performance of real estate companies, whereby real estate companies fill in this survey, and then they are rated and benchmarked against their peers by GRESB, And this has become a very popular tool by investors to use to determine the true value of the overall value of their real estate portfolios, and indeed the individual companies that they're also investing in. And we believe that this particular trend is going to increase also in coming years and evolve, and we see this as a very exciting space also for the direct work that we're doing here internally in Sustainalytics, as we directly use sustainability reports of real estate companies to assist our ratings and analysis of them. So that's an overview of the key industry trends that we focus on in the report, and now I will move over to the special governance spotlight section in the report. And as I mentioned at the beginning, here we focus on the complexity of real estate investment trusts and also the accountability challenges associated with family businesses. And if we focus on the complexity of REITs first, what we do in this report here and in this particular chapter is we highlight that the actual structure of REITs themselves are ripe for governance abuse. And this is because these particular companies do not pay any tax on their earnings. And these earnings, 90% if not all of them, cannot be retained or reinvested. They need to be paid out as dividends. And as a result, a diverse range of mechanisms are needed to manage the cash flows of these companies. And traditionally, what the companies have done, these REITs, is to outsource the management of these cash flows to external managers. But due to the nature of the REIT sub-industry and indeed the real estate sector more broadly, these external managers are often affiliates of the actual REIT sponsor or owner themselves. So this raises obvious conflict of interest concerns between the management and actual ownership of these REITs. And this is actually exacerbated by the fact that these external managers are paid on an assets under management basis as opposed to a performance basis. So this can incentivize these managers to acquire a large amount of suboptimal property that could divert value from the unit holders of the REITs themselves. And we highlight some scandals related to this and fraudulent activity and self-dealing in the sector in this particular chapter. And we also mention how, as a result of these particular scandals, that there has been a move in the US now to try to internalize the management of these REITs. But nevertheless, there's ongoing concerns over high levels of remuneration for these managers of the REITs. But it's not all doom and gloom. We also highlight some good stories in this particular chapter, and one in particular is related to Capital Land Limited, which is a Singaporean organization who, despite still operating with this external management structure, have a very good governance track record and are actually scoring very highly in our governance ratings. As you can see here on the screen, they have been ranked as 4th when it comes to our governance analysis of companies involved in the diversified real estate sub-industry. And following on from this, we move to family businesses. And we focus on, as I said, the accountability challenges associated with them. And we start off by documenting how family-run businesses are characteristic of the real estate sector, especially in Southeast Asia. And when we do so, we by no means want to state that all family-run businesses are corrupt or have the potential to be so, but we highlight how it definitely increases the opportunity of self-dealing and fraudulent activity at the expense of minority shareholders, especially in the absence of any independent oversight. And we document some well-known and notorious scandals and affairs associated with the Chinese estate holdings company, for example, in this report. But again, we try to offer some positive outlooks for the industry when it comes to these particular activities at the end of the chapter by highlighting that both regulators and investors can do a lot to raise awareness about these governance and accountability concerns and actually actively try to address them as well. And I will finish by just a quick overview of some of the recommendations that we make to investors when it comes to dealing with affiliated entities in the real estate sector, and also in particular associated with REITs and family-run businesses, and also with regard to REIT manager fees. So just quickly, in terms of how investors might be able to deal with affiliated entity transactions, we would encourage investors to look for clear disclosure of relationships between entities. We would encourage them to seek independent oversight and approval of transactions, and we would also request them or encourage them to request objective and transparent property valuation processes. And then similarly, when it comes to addressing REIT manager fees, we would encourage investors to look for performance-based rather than asset-based fees, to seek transparency of fee arrangements, and also to request shareholder approval of material fee changes. So that brings me to the end of our special governance spotlight chapter, and I would now like to pass over to my colleague Doug, who is going to provide you with a detailed introduction to the 3 key ESG issues that we focus on in the report and the associated key performers related to these issues.
Thanks very much, Niamh. So as you can see here, our entry point into the conversation is to first figure out which ESG issues are most material for real estate investors. And our approach uses a materiality matrix. And as you can see here, we've identified 11 issues in total that we believe are of concern to investors, but 3 in particular, in our view, have potential to have significant upside and downside effects. These are energy use and greenhouse gas emissions, what we term product sustainability at Sustainalytics, as well as business ethics, which overlaps with the issue of bribery and corruption. So what I'll do now is walk you through our analysis for each of these 3 key ESG issues. If we can just move to slide 10, please. Thank you. So the first key ESG issue, and this obviously dovetails with much of the key industry trends that Niamh highlighted, is energy use and greenhouse gas emissions. And we think this is a significant issue for investors for several reasons. Perhaps first and foremost, I mean, simply from a macro perspective, we know that the real estate industry has a very large energy and emissions footprint. You can see there that buildings account for approximately 40% of global primary energy consumption and just over 30% of global CO2. You know, so clearly a very, very substantial footprint. And what this means is that the sector is highly exposed to the prospect of greenhouse gas regulation. And I say prospect because, in my view, greenhouse gas regulation to date and the associated regimes, such as the emissions trading scheme in Europe, have really had a modest impact, I would say, on real estate operators and companies. And that's because most of the focus in these regimes to date has been on large industrial and manufacturing facilities as opposed to buildings. But that's certainly not to suggest that the bar is not being raised across the real estate industry. It's clear that regulators are pushing building owners for more transparency around energy use. And again, as Niamh mentioned, there's a multitude of incentive programs emerging to help drive improvements in energy and carbon performance. And actually, we found that some of the most interesting developments are taking place at the city level. This is based on the good work of the C40 Cities Climate Leadership Group. They chronicle a whole range of initiatives taking place in cities like London, Sydney, Hong Kong, and Singapore, which again, as Niamh showed, is helping to drive that rather substantial penetration of green building in Singapore. But notwithstanding this trend, I do think the main challenge for investors and real estate companies themselves is really to find a way to capture the energy efficiency opportunity. And what I mean is that despite this, this growing nudge that we're getting from regulators, it's clear that the existing built environment is operating well below its energy efficiency potential. Now, back in 2009, as some of you know or may know, McKinsey famously referred to energy efficiency in the real estate industry as a market failure worth about $130 billion a year. And this refers to the economic value of energy cost savings that are not being captured, and that's in the US economy alone. So I can't say that we came up with any novel suggestions in our report about how to capture this value. It's obviously extremely complex. The key hurdle, what it boils down to, is this idea of the split incentive problem. Again, this is a pretty conventional area of study in the industry, but essentially building owners are not going to invest in retrofit projects if the benefits accrue to the occupant. And as a result, there are any number of NPV positive energy efficiency projects in the built environment that are getting passed over by management. And even simple projects like replacing lighting fixtures, installing energy management technologies, upgrading heating and cooling systems, insulation. These projects are not going to grab headlines necessarily, but that doesn't mean they can't deliver economic savings. And thinking about solutions in our study, we obviously review the literature, and something that we think will help capture this opportunity going forward is the proliferation of big data and the Internet of Things. So the Internet of Things is expected to include about 50 billion objects by 2020. And this could really help, in my mind anyway, unlock some of this value, because what we found is that, and again, this is not our work, but we're citing empirical studies, a lot of the challenge is the result of poor communication. And as one anecdotal example that really stuck in my mind is this idea, we found some studies that showed that in large commercial buildings, particularly in shoulder seasons, it's not uncommon to find instances where heating systems and cooling systems are running simultaneously. So again, this kind of illustrates the efficiency that could be captured through improved communication. Now, this idea that the industry is a long way from the efficient frontier, it shows up in the fact that only, as you can see in the graphic on the right-hand side of your slide, only about 1/3 of the 286 companies in our universe, over 1/3 do not disclose any type of greenhouse gas reduction program, which at the end of the day is all about energy use. You can see there that just under 1/4 disclose what we consider to be a top-tier greenhouse gas reduction program. So this would include things like quantitative targets and deadlines, and it would apply enterprise-wide. So top performers on this indicator would include Mahindra Life Space Developers in India, as well as British Land and Swire Properties in Hong Kong. These are all companies that we argue have a top-tier greenhouse gas program in place. So if we can just move to slide 11, please. So how do you figure out how companies are exposed to this issue of energy use and greenhouse gas emissions? It's actually quite complex, and our toolkit used a multitude of different indicators. We looked at basic environmental policies, the extent to which companies have their systems or management systems certified by external parties. We looked at obviously greenhouse gas reduction programs themselves, and we also measured their disclosure as a proxy for sophistication. Now, in our report, we segment the top performers by developing and emerging markets, but for the sake of brevity here, I'm just showing the top 5 overall. And again, you can see here, Mahindra Life Space Developers, we really like on this issue, Land Securities Group, two companies in Australia, Mirvac and Dexus, and again, City Developments, which again, as a company you're going to hear a lot about today. We're pretty, we really like their strategy on greenhouse gas emissions. So yeah, I guess in general, to close out this thought, we argue that these companies have a relatively sophisticated approach to energy and greenhouse gas management, but the industry as a whole, we take a neutral outlook. We think that disclosure, despite the gains we've seen, is still not where it needs to be, and we expect that over the short term, certainly over the short term, a lot of financial value will continue to be locked up in these energy efficiency projects that are not getting executed. So with that, we can move on to slide 12. So our second key ESG issue is what we call product sustainability. And in the context of the real estate sector, this really translates to green building. Now, you might be wondering what's the relationship between these two issues. The way we did it in the report is we the first chapter on energy use and greenhouse gas emissions was really concentrated on the existing built environment, whereas for product sustainability and green building, we really looked at new builds. Now, when we speak about green building, what we mean is the construction of residential, commercial, and industrial facilities that either meet external certifications like LEED or BREEAM are obviously top of mind, but otherwise exhibit beyond compliance resource efficiency. Now, it's not as easy as one might think to size this market, because despite these standards, there really is no common overall definition of what constitutes green building. But the studies we reviewed, they estimate the size to be about $260 billion, with 325 million square meters of green space added to the built environment last year. Again, this echoes what Niamh said. The market's growing at about 13% a year, and I think it's a little bit, it is easy to get caught up a little bit in the green building movement. The truth is, despite the enormous growth we've seen, it still constitutes about 1% of the overall built environment, and that's because, from a valuation standpoint, I mean, because the global stock of real estate is valued at about $29 trillion based on the studies we've seen. I think the main message for investors is really that the share of green building in the built environment is increasing very quickly. And just as one stat, in the US, 20% of all new commercial real estate construction in 2013 was in green building. Now, we go to great pains in our report to show that this phenomenon, it's not being driven by policies, it's being driven by simple economics. So of course, policies such as the well-known building directive in the EU, which was passed in 2010, is helping to drive this phenomenon, as well as increasingly ambitious building codes. But at the end of the day, what we see happening is that developers are turning to green building because it just makes economic sense. Now, there's been a lot of empirical research done on the topic. Does green building pay off? So first, you have to think about the premiums that have to be incurred in order to construct green building. Again, this is not our own work. This is citing empirical studies. But according to the World Green Building Council, the average cost premium for LEED buildings, as a proxy for green building, can range from about 8%, and this is compared to a basic two-code structure. That's for LEED Platinum, to 2% for LEED Certified. Now, does it pay off? Most of the studies that we reviewed were essentially unequivocal in their findings that green buildings outperform their non-green peers, whether we're talking about occupancy levels, rental rates, or sale prices. And in terms of the financial statements, there's an emerging, and I think truly fascinating, body of evidence coming out, testing to see, do REITs with a higher concentration of green buildings outperform REITs that have a lower concentration? And again, some great work has been done on this by GRESB, and the emerging evidence seems to suggest that yes, REITs with a higher concentration of green buildings or otherwise meet higher sustainability standards have higher ROE, higher ROA, and again, there's more evidence coming out to suggest that a portfolio of REITs with a higher concentration of green buildings can outperform in terms of shareholder value. Again, I just want to stress this research is in its early stages, but we certainly expect it to intensify going forward. We read with great interest a couple days ago that the large Dutch pension fund, PGGM, announced an initiative to map its entire global portfolio of buildings on sustainability, presumably with an attempt down the road to improve efficiency. So we definitely see this as a harbinger of where the industry is moving. So with that, we can, yes, thank you very much. So you can see here, these are some of the leaders that we like on the green building issue. Our toolkit for assessing companies' performance was more concentrated than it was for the energy use and greenhouse gas emissions issue. We looked at 4 indicators. Obviously, we looked at the concentration of green buildings in a company's portfolio. We looked at life cycle analysis programs, as well as industry memberships, so REITs and other companies that have signed up to green building councils and things like that. So as you can see again on the slide, City Developments Limited from Singapore fared really well in our model. This is a company, it's allocating about it discloses it's allocating between 2 and 5% of its overall spend on green design, as well as Unibail Rodamco. This is another one that really stuck out for me. Some of you might remember back in 2014, this company grabbed headlines because it issued one of the first ever green bonds against a portfolio of green buildings. This was a 750 million euro bond, which was one of the first of its kind. So in terms of industry outlook, perhaps needless to say, given my enthusiasm on the issue, we take a positive outlook. We do think that going forward, green building is going to become more and more of a mainstream phenomenon. So the third and final key ESG issue we looked at is associated with business ethics. Now, the materiality driver here is really that the scope for ethical misconduct in the industry is increasing. Again, this ties back to what Niamh said in terms of the capital that's flooding into the real estate industry in this yield-starved environment that investors are operating in right now. And this is putting upward pressure on valuations. And what that means is it's creating more and more pressure on real estate companies, especially in emerging markets, to engage in unethical practices in order to secure land and development contracts. And in recent years, we've seen several fairly high-profile prosecutions of real estate executives that have been hit with bribery and corruption scandals. This includes Chinese Estate Holdings. This was back in 2012, so it's a bit dated, but that obviously set a bit of a shockwave through the sector, as well as Sun Hung Kai Properties, which lost about 5 billion in market value after it got caught up in a scandal as well. And there have been several other less severe incidents. And the other issue is money laundering. It turns out actually that real estate transactions, partly because of their layered nature, it's an ideal way to convert illicit funds into legitimate funds. In other words, it's a vehicle for money laundering. And I was reading the paper just the other day in Canada, and the federal government, this is just one example of how this issue is hitting home, has just launched a money laundering audit of Vancouver's booming real estate industry, because they're finding that more and more very large real estate transactions are being conducted on a cash basis, and this is mostly from offshore buyers. So really it does open up the potential for significant money laundering. So we can go to the next slide, please. Now, from an investment standpoint, I think these major corruption scandals that we flagged, they do tend to be rare, but I think the issue is that when they do occur, they can have major effects on the financial performance of the REITs going forward, as well as reputational effects. And we do cite in the report that some regulators, such as the Securities and Futures Commission of Hong Kong and the Monetary Authority of Singapore, are taking action. They're tightening up governance and management of REITs. And of course, everyone knows that China now has launched a pretty major initiative to clamp down on corruption. But among companies themselves, we've certainly not seen a strengthening of ethical codes or disciplinary measures. Although, as Niamh said in her section, transparency at the margin, I would argue, is improving. Can you go back to slide 14 just for 1 second, please? Thank you. So again, how does this show up in our indicators? Well, you can see here in our bribery and corruption policy indicator, almost 40% of the companies in our universe do not disclose any type of statement or policy on this issue. Only 12% of the companies in our universe have what we consider to be a strong policy. An example here would be Mirvac Group in Australia and Foncière des Régions in France. And the reason we like bribery and corruption policies, we of course recognize that a policy is no guarantee of future performance, but it really is a foundational piece for real estate companies because it does set standards of behavior on ethical issues, how employees ought to treat conflicts of interest and fair dealing and things like that. Now, I don't have the the graphic on the slide, but on our money laundering indicator, disclosure is even worse. So over 80% of the companies in our universe don't have any type of statement, let alone a policy on money laundering, and only 18% have a good policy. And examples there would be a Lend Lease Group in Australia, and again, Unibail Rodamco in France. So now we can go back to 15. Thank you. So again, I mean, figuring out how companies are exposed to this issue is complex, and our approach was to not only look at policies. So obviously, the bribery and corruption policy indicator I talked about, our money laundering indicator. We also looked at whistleblower programs, so the extent to which companies have implemented these types of programs, and then of course we also looked at incidents. So you can see here, these are the companies that fared well in our model. You know, perhaps surprisingly, China Vanke, which is one of the largest developers in China, it actually does stand out from a lot of its peers because it does have a reasonably good bribery and corruption policy. It doesn't get our full marks, but it does have a pretty good policy in place, and it does have a very advanced whistleblower programs. And the company has managed to sidestep many of the controversies that its peers have been hit with. And you can see there other top performers have a similar policy structure. Unibail Rodamco, KLCC in Malaysia, Mahindra Lifespace Developers, which again I called out earlier in the energy use section. So again, just to stress, I mean, we're certainly not of the belief that policies are necessarily going to ensure that companies can completely dodge these types of ethical lapses that we've talked about. But we do think that, generally speaking, companies that have articulated a vision, a policy vision on this issue will be better prepared. And our outlook for the industry as a whole is neutral. We certainly don't expect a radical shift in industry norms on this issue going forward. So up until now, I've talked about leaders on our 3 key ESG issues, but I thought it would be interesting to show our overall leaders. So this encompasses not only the 3 key ESG issues, but our full whack of indicators covering all key ESG issues in the materiality matrix. And you can see here there's a pretty strong overlap. In other words, companies that are performing well on our 3 key ESG issues, as you might expect, are fare well from an overall standpoint. The top overall performer in our model was Unibail Rodamco from France. And you can see here the usual suspects that I talked about: City Developments Limited in Singapore. We didn't talk about Atrium in Sweden, but they were just on the cusp of the top 5 position on virtually every issue. And you can see there in the emerging markets, Mahindra Lifespace Developers in India really stands out. Again, China Vanke, and another company we didn't talk about is Growth Point Properties in South Africa, but a comparatively advanced performer for the emerging markets. So that really concludes our analysis of how companies are positioned on the 3 key ESG issues and our overall findings. So I guess, I mean, maybe to sum it up, I think we do expect to see some progress on these issues going forward, but you know, certainly in the short run, we do expect that a lot of financial gains will continue to be left on the table from an energy standpoint. And we also argue in our report that going forward, investors really should not ignore the downside potential or impact of bribery and corruption issues. So with that, I can turn it back to Hendrik, and we are happy to field questions.
Yeah, many thanks to Niamh and Doug for this insightful presentation. I hope you all share this view. And I think it's fair to say that the real estate sector is one of the most interesting ones to look at from an ESG integration perspective. And what differentiates it from many other sectors is that ESG is factored in more from an economic opportunity than from a pure risk perspective. So while my colleagues were presenting, we received a lot of questions from participants covering a broad range of issues and perspectives. We have another round about 15 minutes left, so let me, without further ado, start with the first question which we received from the audience. And this is about the role of regulators, actually. And the question is whether, and I read it to you, if the green building market is currently being driven by favorable economics, are regulators going to have less of a role to play in driving the uptake and evolution of green buildings across the industry in the future? So what is the role of regulators in a market that is driven by more or less by an economic rationale? And maybe I give this question to Niamh.
Sure, thank you very much, Hendrik. That's certainly a very interesting question. And as Doug mentioned in his presentation, yes, I think a main driver for the growth in green building at the moment is quite simply this positive internal rate of return that investors are witnessing when it comes to the green business space and green building space. But I think we have to remember that this is one, albeit very important driver, but there's other drivers too, and I don't think we can rule out the ongoing need for and indeed very important role of regulators in this green building space. I mean, as Doug highlighted in his presentation and as we go into in more detail in the report, there's quite some segments of the real estate sector, not only in emerging markets, that have been very sluggish to get involved with energy efficiency and green building activities. And we note in the report as well that we actually feel that this is where the role of the regulators is going to become even more important in coming years to try to incentivize and catalyze these sluggish dimensions of the real estate sector to actually start to become more active when it comes to green building and real estate. And I think the initiatives that were briefly mentioned by Doug are going to continue to be very important, such as the legislative drive in the EU, their 2010 directive, which stipulates that all new buildings need to be zero energy buildings by 2020, and all public buildings need to be zero energy buildings by 2018. And that's going to, have ongoing positive influences, we would hope, in, as I say, catalyzing these real estate companies to really start to take this more seriously. And in turn, this is going to continue to lay the foundation of these favorable economics for investors. So I think just to wrap up this particular question, I don't think regulators are going away anytime soon. I think it has to be a team effort between regulators, investors, the industry as well, in terms of their own activities when it comes to green building councils and so forth. And also, there's a very important role here for stakeholders, broader customers and occupants of buildings to drive the continuous demand for green and now more socially oriented buildings as well. So I hope that kind of answers the question for the listeners.
I can maybe just, while we're sorting through the questions, I can maybe just echo what Niamh said. Yeah, I completely agree. I don't think regulators are going away anytime soon. And the other issue is that, the upcoming, everyone has their eyes on the upcoming Paris summit taking place in a few short weeks in November and December. And there actually is an entire day or entire breakout session devoted to real estate. So, it's unclear what's going to happen, but it's simply because of the relatively substantial emissions footprint of this industry, you have to think that it's it could ultimately end up in the crosshairs of regulators in terms of achieving rapid progress because of all the low-hanging fruit that hasn't been captured.
Yeah, thanks, Doug. So sorry, I was muted before. I have another question that is quite related to that, and you might follow up on, Doug, because it's directed to you. You distinguished in your presentation between the existing building market and the new building buildings market, and you talked about market failure and the split incentive problem with regard to the existing buildings market. So, and the question from the audience was, do you see any differences between or any difference between the role of regulators in one versus the other market segment?
Yeah, I mean, it's a common dichotomy in the real estate industry to think about the two sides, the existing buildings, the existing built environment, and the new builds. And historically, regulators have targeted the latter. And I think that's simply because it's easier to apply. In other words, you set a new standard and say, from now on, all buildings have to meet this type of energy efficiency, performance standard, etc. Certainly that's what we've seen in the markets we've looked at in detail, including here in Toronto, for instance. However, I have to say I was a little bit surprised because we also found in our study that a surprising number of initiatives are also targeting the energy efficiency standards for the existing buildings as well. So I certainly don't want to give the impression that regulators only have their eye on new builds. That's certainly not the case. And again, as Niamh said, the relatively well-known example in the EU of the 2010 legislation that targets existing environment as well. So I think most of the time regulators are targeting new builds, but they also target existing built environment as well.
Excellent, thank you. And here's a question to Niamh and related to completely different part of your presentation, and it is about the governance issues side. So one of our participants is asking whether investors should be concerned about the addressed governance issues, not only with respect to emerging markets as presented, but also to developed markets.
Oh, yeah, I think certainly, as we outline here in the presentation and also in the report, of course, I mean, governance in the sector it's an ongoing concern. Certainly, there has been improvements to different dimensions of this in recent years, as we noted in terms of, the move in the US to try to internalize, for example, the management structure of the REITs. The increase in overall transparency throughout the sector as well has improved certain governance dimensions throughout all the different sub-industries in real estate as well. So despite the fact that we see some improvements, there's ongoing concerns. There's ongoing concerns about the high levels of remuneration for the managers with regard to REITs. There's ongoing concerns in terms of, the potential for fraudulent activity and self-dealing, as you say, not only in emerging economies. I think that the issue is that why we focus a lot on emerging economies here is that, in our particular sample, 127 of our overall companies are coming from Asia Pacific. So that's why we have maybe a little bit more of a stronger slant in our presentation and report focusing on governance in Asia Pacific. But governance in real estate is an ongoing concern throughout the sector, and it should be for the investors, as Doug highlighted, throughout the business ethics dimension here of his presentation and also in the report too. There's a lack of concerted effort in large pockets of the industry to have basic business ethics and codes of conduct related policies and to then implement them, and that's directly related to overall governance of the companies. Maybe Doug, you would like to add something as well to that?
You covered it really well. Yeah, I would echo all those comments. Nothing further to add.
Okay, excellent. And here's a very short, snappy question, and it's directed to Doug. So do you consider real estate to be a separate asset class?
Well, it didn't used to be. It didn't used to be, but I think most investors now do consider real estate to be a separate asset class, and there's lots of work being done to show real estate. In fact, I mean, one of the drivers, in addition to the ones Niamh mentioned, was that it has been shown to have a relatively low correlation with other asset classes. So coupled with the stable, relatively stable cash flows, I think this is helping to drive more and more investor interest. Although one thing I'll flag is that one of the findings from our report is that large institutional investors, we certainly know they're ramping up their allocation to real estate. We cite a study that showed 10 years ago the average institutional investor had about 3 or 4% of their portfolio allocated to real estate, whereas today it's closer to 9 or 10%, and we expect it to increase going forward. Their preferred vehicle for playing the real estate sector is through private real estate funds and things like that. So they're sort of foregoing the REIT opportunity.
Interesting. And another area that that is covered by the questions that we receive is related to the question of a movement from, let's say, more the pure green building market to the sustainable building market. So can you please elaborate a little bit more on that? How significant is this trend? What do you expect there? And maybe related, and I can bundle two questions actually. Another one was on the well-being standards. So in which countries are these already well established? And what do we expect with respect to the US? When will they take hold in the United States? So this is directly to both of you. I don't know who wants to start. Ladies first, Neve.
Yeah, okay. Certainly it's very early days yet, I would say. As I mentioned in the report and also in the presentation today, the well building standard was only launched at the end of last year in October, and that was in the US. So it's going to take some time to have some traction, as of course was the case with the LEED building standard as well. But already this year we see that it has been rolled out in China, which is very interesting. And I think there's going to be a lot more spin-off effects from that as well internationally now, judging on how successful it will be in China. But I think, you know, with any of these type standards, there's a certain lag period between when they're introduced and then accepted countrywide and then implemented, and the actual effects will be, you know, 2 to 3 years, I would say, down along the line. But certainly, given the interest in China, for example, a major economy and one of the most important ones in our report as well, I think this is a very, very interesting and important space to watch over the next, as I say, 2 to 3 years, if not longer. And I think this is going to have spin-off effects on a number of different sustainability-related tools and measures and benchmarks, as we mentioned with GRESB as well earlier. I mean, we'll probably see the evolution now of sustainability performance and reporting to encompass more of these social dimensions of building and real estate, and to really focus down on this human dimension, looking at well-being and occupant health and also productivity, as I mentioned in the presentation, in a lot more detail than has been developed in the past. And this is going to have obvious spin-off effects, as I said earlier, too, for our particular work here, because internally, in terms of the indicators that we're using for the real estate sector, we may probably need to either reduce some of the green indicators that we're using and refine them and introduce new socially oriented indicators. I think certainly in a nutshell, because I'm conscious of the fact that we're coming up to 4 p.m. now, this is really a very interesting space going forward.
Yeah, thank you, Neve. And actually, looking at my watch, it is 4 o'clock, and hence we have arrived at the end of this webinar. So those questions that we were not able to answer in this session, we will come back to you individually. So let me close the webinar by saying thanks again to our presenters, Neve and Doug. And of course, also in the name of Sustainalytics, many thanks to all participants, to all who participated in this webinar. We hope that you have gained valuable, fresh insights that help you to integrate ESG in your investment decision-making processes. And many thanks again, and we hope to welcome you again to one of our forthcoming webinars. Goodbye.